And the Outlook series continues. Today we have Gary Wagner and Chart This. Gary, thanks for joining me today.
My pleasure to be here.
All right, Gary, big news coming out this week with the Fed earlier in the week. What did you make of, the bit of a mess that came out of it?
Well, I mean, on one hand, when the Fed met, I saw this as being some real transparency that rates aren't going to be raised at least the first quarter of next year. The one interesting thing is there was a change in the vocabulary that was used, and they added the word patience. And it's interesting to see how market technicians and analysts will take a single word and try to pull it apart in 5 different ways. But I think that there's good transparency. I think that it signals a continuation of the economic recovery in the United States that we have seen really throughout 2014.
Now, Gary, as the year comes to an end, what are the key levels that you're looking at setting up gold for 2015?
Well, I'm working with 2 different models right now, and we'll talk about that, of course, on the insert. But the key levels that we really have to see taken out on the upside, we had a recent high at 1254, but we had a failed top, and that came as high as, I believe, 38 or 40, 1238 or 40. 41 is another very, very important number in terms of resistance. Now, in terms of support, we are trading under 1200, but we've been hovering back and forth between that number. 1180 is a pretty key number, and of course 1131, which is the most recent intraday low that we had as the market came down.
Now, Gary, we know that you brought us some special inserts for Outlook 2015. What analysis do you have for us and our readers?
Well, this particular insert will be our Gold Outlook 2015. We'll explore a couple of different models that I'm currently looking at that I feel have the highest probability in terms of the way we will see gold unfold towards the end of this year, first quarter of next year.
Let's see what you have.
It is hard to believe that another year, 2014, is coming to a close. We once again take a look at the past year very, very briefly in gold, as well as our forecast for 2015. What we're looking at when we look at these composite charts sitting up here is the dollar index, Standard & Poor's, and then 2 gold charts. When we take a look at what we saw this year is considering the Standard & Poor's or the equities markets, that arrow represents where we were at the beginning of 2014. You can pretty much see we've moved to the upside to new record highs. When we look at the dollar index over this last year, we have just come back up to a high that we haven't really seen since about mid-2010, right above 89, but we're at definitely a new high prior to that. When we consider the moves that we've seen in the equities markets, the US dollar, and then we look at gold, you can see that gold was pretty much trading at $1,200 at the beginning of 2014, and now close to the conclusion, we're pretty much dead even, trading currently at $1,196. Oh yes, and one last thing to consider or to add to the mix during 2014, and that is oil prices. Looking at a weekly chart, since it began just above $90 at the beginning of 2014, traded to a high of just under $110 per barrel, and now is just trading above $50 per barrel. In fact, considering the kind of moves that we have seen in the equities markets and the US dollar, the one thing that we can say is that this year has been defined as an absolute consolidation within the gold market. And when we compare this to the activity of 2013, which saw a 30% decline, consolidation is not such a bad thing. So what can we look for in 2015, and where do we forecast gold prices going? I'm working with 2 distinctly different models. I'm going to try to cover both of them for you on this Outlook 2015. But the one thing that we have to really pay a lot of attention to is the current trends we have with a higher dollar, higher equities, and lower oil. Because if these 3 things continue, I really see no other place for gold to trade but under more consistent pressure. And with that in mind, this is my current bear model in gold. This model is actually predicting or looking at lower pricing over next year, and fairly substantially lower pricing. It's really based upon a couple of factors. Most importantly, when we take a look at the longer term activity within the market, we have had a series at this point of lower highs. Now, we've also had a period of equal and now lower lows. That, to me, of course, signals a potential for further downside pressure in the market. More importantly, the fact that it could not, on this last rally, this $100 rally from these new lows at 31, go in and break out above either the resistance line or the former top, which was 1154, meaning we got a lower high again. That also beckons to me the possibility of lower prices. So within this model, I'm really looking at this price point here. This is 1180. And then, of course, we have another one now at 1131. But the key is, when we look at our longer term studies and we consider the 1154, now that is a 61% retracement from this last major rally, call it 700 to 1900. 1154 takes you to a 61% retracement. If in fact we do see gold breach that critical level, the 61% retracement level, and start to head towards the most recent lows at 1131, we could see dramatically lower pricing, and the prices that I would be looking at are going to be based upon our Elliott wave model. It is my current take in the market that we are in a fifth wave off of this corrections wave 1, 2, along wave 3, wave 4, and we are currently immersed in wave 5. One of the techniques that we use to forecast the fifth wave is to say that wave 1 and wave 5 are roughly equal. If I do that, and this is a scalable line, I take this to the top of 4 or the beginning of our fifth wave down here, that would forecast or predict that gold prices could go as low as 959. There is also a second technique that we use, and that is to take our range from our third wave and then to create an extension, which we have, that will begin at the onset of our fifth wave here, and then look for wave 5 to be about 61% of wave 3. When we run that analysis, we come up with the very, very same price point. So if we see dramatic pressure continue in gold and it breaks through new lows, our prediction is we could see prices fall as low as 1033 to 959. There's no doubt, according to this particular model, and it is the model that I favor the most, we are looking at potentially lower pricing ahead in 2015. However, there's also a bullish model that can be made as long as gold can remain above, in terms of a price point, 1154, and move off of that point to higher ground. Because of time permitting, I will be putting our second model, which is our bullish model, up on our website as part 2 of our Gold Outlook 2015. To view part 2, simply go to our website, thegoldforecast.com. There you will see a button that looks something like this, Gold Outlook 2015. Go ahead and click that, and that will take you to part 2 of Gold Outlook 2015. It has been a distinct honor as well as a privilege to work with you and present our technical analysis through the Chart This series here in 2014, and I hope to bring you insightful technical studies again in 2015.
Great stuff, Gary. Thanks for that. Before we let you go, is there anything special going on over the holidays in Hawaii?
Well, as we say in Hawaii, Mele Kalikimaka, which is Merry Christmas, and the only real special thing is we do have a Santa in shorts, and you will find him occasionally surfing.
Great, Gary. Thanks. All the best over the holidays.
Want to wish all of our Chart This viewers a great and successful 2015. Health, happiness, and prosperity. As long as we have those in our family, we've got everything that we need. Have a great day and a great year.
And thank you for watching this edition of Chart This Outlook 2015 edition. Remember, we have coverage of the Outlook series going on until January 5th, so keep coming. Have a great weekend.